Richard Holden. Money in the 21st Century. Cheap, mobile, and digital. Money is changing in ways that most people didn't see coming. It's no longer just notes in a wallet or numbers in a bank account. It's embedded in apps, managed by algorithms, and increasingly shaped by forces beyond traditional institutions. What once felt stable and predictable is now evolving rapidly, driven by shifts in technology, policy, and global behavior. In this blink, you'll discover how three powerful trends have redefined what money is, how it moves, and who controls it. These forces are already reshaping economies and financial systems around the world. To understand where this change is heading, it helps to start with when it truly began, and how a few major shifts in 2008 quietly set new rules for modern money. Why modern money is no longer what it was. In 2008, three developments quietly emerged that would later upend the foundations of global finance. Interest rates in wealthy countries fell to near zero. Smartphones became widespread, and Bitcoin was born. These trends marked the beginning of a new era in how money is created, moved, and controlled. The drop in interest rates was the first clear break from the past. In response to the global financial crisis, central banks slashed borrowing costs to jumpstart struggling economies. But the real surprise came afterward. Rates stayed low for years, even as conditions improved. This shift reflected deeper changes in how the economy works. Today's leading firms can scale globally with much less capital than older industrial giants. At the same time, aging populations and rising inequality have led to excess global savings. With more money chasing fewer investment opportunities, the natural rate of interest has collapsed. That explains why cheap money has become the default, not the exception. Meanwhile, the mobile phone evolved into an everyday financial tool. Within a few years of the iPhone's release, digital payments had become routine in much of the world. From grocery stores in Europe to informal markets in East Africa, people began using apps and mobile wallets to pay, transfer, and manage money. They no longer needed a physical bank. Then came Bitcoin. Built on a decentralized ledger called blockchain, it introduced a new model: digital money that operates outside government systems. What started as a niche experiment has grown into a vast ecosystem of private digital currencies with real economic weight and political attention. These three forces, cheap, mobile, and digital, are the foundation of today's monetary shift. You'll take a closer look at each of them in the sections ahead, but first, it's worth understanding what happens when cash itself starts disappearing from everyday life. The world is moving beyond cash. In 2010, almost 40% of Swedes used cash for their most recent purchase. By 2020, that figure had dropped to just 9%. That kind of shift signals a deep change in how a modern economy handles money. Across much of the developed world, and increasingly in developing regions too, cash is quietly being replaced by faster, safer, and more trackable digital alternatives. The move away from physical currency is largely driven by technology. With tap-to-pay cards, smartphones, and wearable devices, transactions are now instant and seamless. They're often more secure too. In countries like Sweden and Australia, infrastructure like real-time payment systems and mobile payment apps has made digital spending effortless. This isn't a theoretical future, it's already here. What used to require an ATM or wallet now just takes a phone. But not everyone has been eager or able to keep up. Seniors, low-income groups, and the unbanked still rely heavily on physical money. For some, it's about access. For others, it's about trust or habit. Raghuram Rajan, former governor of the Reserve Bank of India, has warned that moving too quickly to eliminate cash can erode public trust and increase inequality. He witnessed this firsthand during India's 2016 demonetization, where the sudden removal of most cash from circulation disrupted everyday life and hurt the poorest the most. This is why thoughtful planning matters, especially when phasing out large denominations or promoting new systems. In places with strong digital infrastructure, like Australia, a phased 3-year plan to eliminate cash is entirely possible. In contrast, rushed policies can cause real harm. Even in highly digital economies, cash still lingers for reasons like privacy, control, or simply comfort. But as the benefits of digital payments become harder to ignore and coordination improves, cash is steadily losing ground. What replaces it next, and who controls it, is the bigger question ahead. Mobile money is reshaping access to finance. In rural Kenya and parts of Afghanistan, mobile phones have quietly done what traditional banks struggled to achieve for decades. They've given people a safe, practical way to handle money. In places with weak infrastructure and limited access to physical banking, mobile payment systems have become essential, and that's redefining what it means to participate in a modern economy. At the core of this shift is the merging of two powerful technologies, the mobile phone and digital finance. What started as a convenience in wealthier countries has become a foundation for financial inclusion in developing regions. Randomized trials in Kenya show mobile money has helped reduce poverty, particularly among women. In Afghanistan, studies found that paying police officers through mobile systems cut down corruption and increased morale. These stories show how digital access to money can reshape social and economic behavior. This change also raises a broader question about how money works in practice. Traditionally, central banks issue money, governments tax it, and commercial banks manage most of the distribution through deposits and loans. But digital platforms are increasingly stepping into those roles, moving money, recording transactions, even storing value. In the background, monetary policy still matters, but the way it works is evolving. Inflation and interest rates still shape how people behave, but now that behavior plays out through screens and apps, not teller windows. In advanced economies, this same technology has made payments faster, easier, and more secure. But the biggest impact may be where formal banking never fully reached. When a phone becomes your bank, economic participation expands dramatically, and that has long-term implications for how countries think about regulation, infrastructure, and growth. The next wave of disruption is already here, and it's running on code instead of cash. The question now is what happens when private currencies challenge this new digital system. Cryptocurrency is challenging state control of money. In a small New Hampshire town, frozen yogurt shops accept Bitcoin, and residents gather to debate the merits of different cryptocurrencies. It sounds like a novelty, but it captures something real. Private digital currencies have moved from fringe experiments to globally traded assets worth trillions. The movement began in 2008, when someone using the name Satoshi Nakamoto published an online paper. It outlined a way to create digital money without banks or governments. That proposal became Bitcoin, the first cryptocurrency. It sparked a wave of innovation that now challenges the traditional state monopoly on money. At the heart of this shift is blockchain, a distributed digital ledger that doesn't require banks, governments, or courts to verify transactions. Instead, it uses cryptographic methods and network consensus to establish trust between strangers. That's what makes cryptocurrencies like Bitcoin and Ethereum more than just digital tokens. They represent a new way to manage and record value without a central authority. This technology changes the rules. It allows money to be created and moved without permission, and that has caught the attention of regulators, economists, and governments around the world. One of the most influential figures in this space is Vitalik Buterin, the co-founder of Ethereum, who launched the platform in his teens. Unlike Bitcoin, which focuses on peer-to-peer payments, Ethereum introduced programmable contracts, agreements enforced by code instead of lawyers or institutions. That feature helped spark an explosion of applications, from decentralized finance to digital collectibles, and created a massive ecosystem around a single network. These currencies are shaped by powerful network effects. The more people use them, the more valuable and entrenched they become. That dynamic could give a few digital currencies overwhelming influence, raising concerns about new forms of private monopoly. Governments are now grappling with how to respond, whether to regulate, compete, or adapt. The next development in that response is already underway: the rise of official digital currencies. GovCoins are states' answer to digital currency disruption. When Facebook announced plans in 2019 to launch its own global digital currency, it set off alarms among policymakers, especially in Washington. The currency was first called Libra, later renamed Diem. The idea of a private tech platform with billions of users issuing its own money raised serious concerns about financial stability, regulatory oversight, and even geopolitical influence. Treasury Secretary Janet Yellen was among those who pushed back, and without US support, the project stalled, but it sent a clear message. Powerful private actors were no longer just proposing alternatives to government money, they were ready to launch them. In response, central banks around the world began accelerating their own plans to issue digital currencies. Central bank digital currencies, often called GovCoins, are now the public sector's answer to the rise of crypto and private digital money. These aren't speculative assets or tokens backed by startups. They're digital versions of national currencies, issued and managed by central banks. The aim is to keep the benefits of state-backed money, stability, accountability, and regulation, while adapting to a world where money increasingly lives on screens, not in wallets. Designing a viable GovCoin means making trade-offs. It has to be accessible, secure, and fast, but it also needs to protect privacy and work within existing financial systems. One proposal for the United States, nicknamed FedCoin, would be built on a centralized ledger controlled by the Federal Reserve. Unlike cryptocurrencies, it wouldn't rely on energy-intensive blockchain mining. It would allow digital payments and smart contracts to run efficiently while giving regulators the tools they need to enforce laws and collect taxes. This shift could eventually lead to the retirement of physical cash. That opens new possibilities, but also raises important questions about privacy, the role of banks, and government oversight of spending. For countries like China, which has already introduced a digital yuan to millions of users, the race is well underway. And as more governments act, the balance between private and public control over money is being redrawn. The next battleground is global. Digital currencies are redrawing global financial power. The US dollar has long held a unique position in the global financial system. It's the world's most trusted store of value and the dominant reserve currency, used in everything from international trade to central bank holdings. But as digital currencies gain ground, this advantage, often called the exorbitant privilege, is no longer guaranteed. A key threat is coming from China. With its digital yuan already introduced to hundreds of millions of citizens, China is aiming to shape the future of money on its own terms. Unlike traditional international finance, which relies on institutions like SWIFT or the US banking system, a digital currency backed by the Chinese state could enable entirely new payment networks outside the reach of Western regulators. That would reduce the global reliance on the dollar and make sanctions and financial restrictions less effective. It's a geopolitical shift disguised as a technical upgrade. The US, by contrast, has been cautious. While the Federal Reserve has explored the concept of a digital dollar, political gridlock and institutional inertia have slowed any real action. That hesitation leaves the door open for competitors, both other governments and large tech firms, to shape the infrastructure of digital payments. And once new systems are widely adopted, they're hard to displace. In global finance, timing and scale matter more than intentions. There's also growing pressure from the private sector. If a company with massive reach, like Amazon or Apple, were to successfully launch a widely used digital currency, it could challenge both governments and international institutions. In that environment, the US risks losing more than influence. It could lose control over key levers of economic policy. The digital future of money is already taking shape, with governments and tech platforms racing to set the standards. But building new systems is only part of the story. The next challenge is understanding how these changes interact with old pressures, like asset bubbles, rising debt, and the limits of public finance. Cheap money is rewriting economic rules. In the early 1980s, interest rates in the US reached over 15%. 4 decades later, rates sat near zero for over a decade, despite record government spending and major central bank interventions. This dramatic shift signaled a deeper structural change in the global economy, one that's reshaping how money flows, how governments borrow, and how financial bubbles form. Today's persistently low interest rates are the product of powerful long-term forces. New technologies allow businesses to grow massively with minimal capital. Think of how companies like Facebook and Google were built on code, not factories. At the same time, global savings have surged. Aging populations in advanced economies and rising inequality have concentrated wealth in fewer hands, and wealthy individuals tend to save more than they spend. These dynamics have driven down the natural cost of borrowing, leaving central banks with little room to maneuver. This environment makes economies more vulnerable to asset bubbles. When borrowing is cheap and investment opportunities are limited, money flows into property, stocks, and speculation. The housing crisis in the 2000s was a warning. Now, speculative assets, from crypto to tech stocks, have become routine features of the financial landscape. Governments can respond with policy, but the underlying imbalance between saving and investment remains hard to fix. Meanwhile, some argue that governments can now spend freely and simply print money when needed. But history, from Weimar Germany to modern Venezuela, shows the risks of ignoring inflation and debt. Even in a digital world, public finance still requires discipline. Issuing a central bank digital currency doesn't eliminate the need for sound budgeting or stable monetary policy. The foundations of money are changing, but they're not disappearing. As economies adapt to digital systems and cheap capital, the challenge is to build a stable, inclusive financial future that doesn't repeat the mistakes of the past. The main takeaway of this blink to Money in the 21st Century by Richard Holden is that money is no longer just a government-issued medium of exchange. It's becoming cheaper to borrow, more digital to use, and increasingly shaped by private platforms and global competition. As governments, central banks, and tech companies race to define the future of currency, the rules of economic power and participation are being rewritten. Understanding these shifts is essential for navigating today's financial world and for shaping systems that are more inclusive, efficient, and responsive in the years ahead. The future of money is being built now, and it's still ours to shape. Okay, that's it for this blink. We hope you enjoyed it. If you can, please take the time to leave us a rating. We always appreciate your feedback. See you in the next blink.